If you've ever been told you don't qualify for a VA loan because your debt to income ratio is over 41%, stop. Do not assume that answer is final because there is one number that makes lazy lenders nervous, and that number is 41%. Once a VA file crosses that line, many loan officers get panicked. They say VA won't allow it or it's too risky. But I am here to tell you that is false. VA loans do not underwrite the same way conventional loans do. There is a piece of math hidden inside the guidelines that overrides the fear of high DTI debt to income. It's called residual income. And if you understand this, you can get approved with a DTI, debt to income ratio, 45%, 50%, and I've even approved some even higher. I'm Cathy Sabater, and today I'm going to teach you the hidden math that saves VA deals. The problem with DTI. Before we get to the solution, I need to ask you, have you ever looked at your budget and thought, my numbers look okay on paper, but my bank account tells a different story? Or the opposite. Have you ever thought, my card payment is high, but I still have plenty of cash left over at the end of the month? That disconnect, that is why DTI, debt to income, it measures how much of your gross income goes to debt, housing, cars, student loans. Now, here is the simple math. If your family makes about $10,000 a month and your debt is about $4,100 a month, your DTI, debt to income, is 41%. Conventional loans treat this number most of the time like a brick wall, pass or fail. But let me ask you another question. Does a family of four in Texas spend the same amount of money on groceries as a single guy or person in San Diego? Of course not. But DTI, debt to income, treats them exactly the same. It doesn't account for real life. And that is why the VA created a better system. Let me introduce you to residual income. The VA asks more human questions. After the mortgage is paid, can this veteran actually eat? That is where residual income comes in. It is real life affordability check. It's also a stress test. So what is it exactly? It is the specific amount of money you have left in your pocket or your wallet, if everything's online, after we subtract everything. We take your gross income, subtract your federal taxes, your state taxes, Social Security, Medicare, your mortgage, and your credit debts. These are the hidden costs. Now, this is where it gets a little tricky. And this is where some VA deals could die. We don't just subtract your debt. We also subtract maintenance costs and family expenses. Let me explain the maintenance math. The VA assumes that owning a home costs money. Fixing leaks, painting walls. So we take the square footage of the home. So let's say it's approximately 2,000 square feet, and we multiply it by 14 cents. That is $280 a month. Even if you don't actually spend that, we have to subtract it from your income as a phantom debt. If your lender forgets to calculate this, your pre-approval could potentially be worthless. And then we subtract childcare. If you pay for daycare, that comes out of your residual income too. So if you have, let's say, 3 kids in daycare, your residual income drops fast. That is why DTI, debt to income, is a liar. Because DTI ignores daycare. Residual income counts every penny. So let's get to the charts and the rules. Now, how do you know if you pass? The VA has a chart depending on where you live and how big your family is. You need to hit a specific dollar amount to be considered safe. So, for example, a family of 4 in the South might need $1,000 left over, but a family of 4 in the Northeast might need $1,100 left over because heating oil is expensive. See the difference? It is logical. Now, here is the rule that saves the deal. I love this part. And this is where lenders get it wrong. If your DTI is under 41%, you just need to meet that minimum number. But if your DTI, debt to income, is over 41%, VA doesn't deny you. They just raise the bar. They say, okay, your debt ratio is high, so we need your residual income. And with that, we need 120% of the minimum. So basically, let's show that you have an extra cash flow to offset the high debt. Do you want to see or hear a scenario? This is the high DTI, debt to income win. Let's put this into real life. Let's talk about buyer A, and let's call him Mike. Mike is an E6, buying a house. He makes good money, but Mike loves his truck. He has a $900 truck payment, and he has a student loan. When we run his number, his debt to income, DTI, is about 52%. If Mike walked into a regular bank, that loan officer would look at 52% and say, sorry, denied, too risky. But I look at Mike's residual income. This is what can save the deal. Because Mike makes good money, even after paying that expensive truck, he still has $2,500 left over every and each month. So this is pure cash flow. So does he meet the minimum? Yes. Does he meet the 120% requirement? Easily. The result, the 52 DTI, debt to income, Mike is approved. Why? Because Mike has cash flow, and cash flow pays bills. Percentages do not. Now, Let's get into the other scenario. And this one is the low DTI trap, debt to income. Now let's flip the script. Let's talk about buyer B. Let's call her Sarah. Sarah is frugal. She has zero car payments. Now, her debt to income is only 39%. Looks amazing on paper, right? But here's the catch. Sarah is buying a huge house, and she has a family of 6, 4 kids. That means her minimum residual requirement is much higher on the chart. So when we subtract the taxes and the huge utility estimate for the big house, Sarah only has $800 left over for a family of 6. The VA says that is not enough, and it's not enough money to buy groceries and clothes. So even though her DTI, debt to income, is safe at 39%, her residual income fails. She might actually get denied, or gotta have a backup, or she could just lower her purchase price. Do you see why DTI, debt to income, could potentially be a liar with a VA loan? The risky guy got approved. The safe buyer may have gotten denied. So let's talk about the tax trap strategy. I want to give you one more secret strategy. This is for the close calls. Sometimes this is what kills your residual income. Here's your pay stub. So if you claim single and zero on your W-4, the IRS takes a huge chunk of your paycheck. That lowers your net income, and that lowers your residual income. But if we know you get a huge refund every year, we can fix the math. We can adjust your tax withholding to show the underwriter that you actually take home more money than what your pay stub shows. I have saved a few deals just by fixing the tax math. This is why you need a strategist, not just an order taker. We check your tax bracket. We check your W-4. We fight for every dollar of your income. So here's my advice to you. If you're a veteran, active duty, retired, and you want to buy a home in 2026, do not let simple math ratios stop you. If a lender says you are denied because of DTI, what is that? Debt to income. Ask them this exact question. Did you calculate my residual income? And did I meet the 120% requirement? If they look confused, or if they say that doesn't matter, run. And if you want to see the exact chart I use to calculate this for my veterans, comment the word residual below. I will reply to you, and I will personally give you the cheat sheet so that you can see the numbers yourself, right? I am Cathy Sabater. I don't just do loans. I do strategy. Make sure you subscribe, because next week topic, we're going to be talking about self-employed income. And that is a whole other beast. I'll see you then.